Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 259 on 12th of July. And I want to showcase to you how momentum can protect you. Momentum investing in its conventional form when it's done. How it can protect you and how, even when the markets are coming down, you are still protected against huge downsides because of the inbuilt criteria of exits. So, but first, a look at the markets. Opened a bit gap down, recovered during the day quite a bit, but then fell down again. Mainly the cues from overseas futures were negative, and cues from other Asian markets were also negative. Today's market saw metals fall back. Yesterday there was some rumor that government is looking to roll back the additional duties on export. That was clarified that there is no such proposal. Autos that had run up probably took some profit booking today. IT stocks which were hammered yesterday continued the downside, although with limited loss today. FMCG also, which have been recently doing quite well, fell down about 1%. Nifty overall down about 1%, along with bank index also down about 1%, and only energy stocks and real estate stocks holding the fort. So we've had several days of upswing since the bottom made near 15,000 and the market reached about 16,200 odd, and now the $1,000,000 question is whether we will keep going up or we are changing direction and going back to 15,000 again. I think, as I mentioned several times before, it is largely dependent upon the interest rates cycle that is going on. So it is anticipated that the Fed will raise another 75 basis points by July end, and the RBI may also raise another 0.5% in the next meet. So this cycle, till it is on, will always have headwinds for the market. Equity does not like higher interest rates. As other instruments start to compete with equity returns, of course they are not as good as equity returns, but given the lower risk, a lot of money starts to flow back into risk-free or debt assets as soon as interest rates start becoming attractive. So, and of course the additional burden on companies for interest to be paid on the debt also reduces their margin. So several factors come together once the interest rate cycle is in full flow. So Nifty Next 50 was slightly subdued at minus 0.33%, but still way better than the index, the Nifty index. Small cap index also mildly down at 0.4%. Mid and small cap index also mildly down 0.5%. So it was not really a sell-off as such, but yes, some profit booking, you can say, did start today. Whether it will blow into a bigger sort of a downtrend we'll find out in the rest of the week, I think. Weekend investing strategies were also in line, most of them, between 0 and 0.5%. Some of them were down 0.9 to 1% also on the fall today. The heat map for the day was all red except for some green at NTPC and some flat stocks at Bharti, which had fallen yesterday. Reliance flat, Adani Ports, Bajaj Auto. Otherwise, there was red all over. Kotak Bank, ICICI Bank, HDFC Bank, TCS, Infosys, Hindustan Lever, Nestle, Tata Motors, Maruti, Titan, Asian Paints, all falling 1 to 2%. Tata Steel, Ultras, Emco, ONGC, BPCL, HDFC Life, and Bajaj Finance also staying slightly flat. In terms of the top gainers in top 500 stocks, Vakrangi, ITI, Balaji Amine, HFCL, and Zomato, after a huge drubbing after they bought Blinkit, seems to be finding its feet. Also because I think the promoters were on television today, and a lot of times this phenomena is seen that when company representatives come and try to explain their business model and forecast, markets gets enthused for a few days, but then sometimes it works, sometimes it doesn't work. In terms of falls, NMDC, REC, Fine Organics, VMart Retail and HPCL all down between about 4 to 5% in today's market. So I wanted to focus on how momentum protects you. So just like you will, we are taking an example of Edelweiss Financial Service. The stock in 15 years has done nothing for its investors. The unfortunate part is that a very dynamic promoter has not been able to deliver the goods for the shareholders, and I know several investors who have just been waiting since the IPO or since later on, and it's just not working for them right now. Anyhow, so momentum would have prevented you from entering into this stock all this while, and possibly you would have entered somewhere here when it started to break above multi-year highs, or at least above this sort of 11-month MA that we've taken here. So you would have got in here and rode all the way from 54 till 330, 340, and then the stock collapsed. So if not here at 280, you would have gotten out at 170 and not looked at this stock again. So just by eliminating stocks that keep going down, by removing that subset of those stocks which are weak from your stocks from where you will pick your constituents of the portfolio, that itself eliminates a lot of negative performance. It eliminates a lot of weaker than market performance, and it keeps your portfolio within some reasonable semblance of the performance versus the benchmark. So you would have not wasted 7 years waiting for this rise to happen, and you would have gotten out maybe at 100-150% profit, not all of it because you would have lost most of it, but still made money, good money, within a matter of 2-3 years. And then for the next 3 years you would not have been waiting anymore. So just imagine the kind of capital this frees up for newer opportunities. So your capital was working somewhere else all this while, it got deployed here, and then the capital again is deployed somewhere else in some other strength in the market. So this is how momentum protects you and makes best use of your capital when many of the stocks are doing nothing. I mean, why do we want to sit in stocks which are doing nothing for 15 years? I mean, we have a finite life and a finite sort of patience level to deal with stocks. Another example that I quoted on Twitter today was how important are exits. So again, the promoter of Thyrocare also exited somewhere here while the stock went from 400 to 1400, and then it just collapsed to 620. Also because of the COVID run already having happened, and immense competition coming into this diagnostic market. So again, even if you are using some simple metrics like a moving average or something, you would have gotten out at a decent price. If you were using a momentum metrics, maybe you would have gotten in here, maybe you would have got chopped out somewhere here, still got in again here, still got out here. So again, what I'm saying is, even if you may not have made money using momentum in this particular example, you would have not lost money. You would not be waiting here last 2 years to hoping that the stock will go back up, or wasting your time all these 4-5 years before the momentum actually came in. So that's how the the natural selection of stocks happens when you have to get in, and of course there is a clear, crisp and demarcated exit at any point of time which you are able to use to get out. Yes, momentum strategies also have drawdowns, but there is a immensely higher probability that you will climb back up, and much faster than any other strategy out there. Other insights were about gold prices in USD versus JPY, that's Japanese yen, versus euro since the great financial crisis. So you can see in the last 14 years, if you had gold in dollar terms, you were up 140%. If you had gold in euro terms, you were up 205%. And if you had gold in Japanese yen terms, you were up 234%. So just imagine investors in Eurozone and investors in Japan who haven't really made much returns since the great financial crisis in their equity markets would have hedged, in case they would have hedged their equity returns and their currency exposure with gold, they would have at least got these returns added to the rest of the portfolio, and overall the whole basket may be looking much better. So this is something that I keep pressing, that this allocation to gold is a great hedge versus your equity exposure. People in Turkey have witnessed it, people in Venezuela have witnessed it, people in Japan and Europe have also witnessed it recently, and it is also a great hedge against your own currency. So I'll leave this one on that. And of course the USD is unstoppable. Right now the USD, the Dixie, is at 108.5, so which is, it is just running amok. And of course about 50-60% of this basket of currencies against the USD is Japanese yen and euros. So now in Japan they have decided not to raise interest rates and to keep defending the yield at 0.5%, so 0.25%, I'm sorry. So they will keep printing more and more yen and warding off that increase of yield. And Eurozone is also in a great sort of conundrum where they cannot afford to raise interest rates also, because so many of their EU zone states are sitting with huge debts, already not able to service their debts, and if with interest rates going up, there are going to be sovereign debt crisis there. So the world is actually stuck in a hard place with no solutions, and this dollar, the more it goes up, the more disruption it will do to non-dollar economies where people have taken on dollar debts, and now they will find it more and more difficult to pay it back, to pay for the interest on the debt. We are seeing what Sri Lanka has gone through. Pakistan is also nearby, and for Indian state, having neighbors who have gone bankrupt is also very scary. So we can only hope that some semblance comes out of this wrecking train that is just going up. I mean, if this goes on for the next few months, I think emerging markets will really have a bad time going through this phase. This has happened in 70s and 80s, where US dollar went from, I think, 20 to 140 or something like that, and it just kept going up and up and up, and so far it is looking just like the same, and it is just going to cause a lot of disruption. That's all I can say. It's very difficult to imagine what will happen, but this is going to disrupt the world in such a way that wars or civil riots, only those are the sort of events that sort of culminate out of such issues that cause imbalance and are taking away from the usual equilibrium. So enough of scary and negative talk. Let's hope that things can come back to equilibrium and we can do well. Our currency so far has not done so badly, although we are near 80 to the dollar. But I think vis-a-vis a lot of other currencies, we are still doing quite all right. Our tax collection is also all right. I think as a country we are doing far better than many other countries, and that hopefully will attract more capital in coming months and years. So please don't wish for change of government. This government has done well so far. I'm not saying it because of any political affiliation, but don't wish for something which can really rock the boat. So with those words, I think this is the end of today's Daily Bite. Thanks so much for watching. Please do like it. If you haven't subscribed it, please do subscribe it and share it with your loved ones. Thank you. Bye.